Hello, welcome to this year's, I still call it the De Montfort survey, although we have a kind of bigger group of sponsors now. Welcome to Alan Overy. I'm going to hand you shortly to Dr. Nicole Lux. This is her first full year with responsibility for this survey, although I see that her predecessor is in the audience to check that standards are being maintained. I'm asked to tell you that in the event of a fire, you will be guided to a safe exit. And I'm asked to assure you that there will be drinks on offer for those who wish to stay at the end outside, as you would have seen on your way in. But we're all looking forward to the results of this year's survey, so I'll hand you over now to Dr. Nicole Lux.
Thank you very much. Yes, thank you all for coming. And yeah, after a long sort of data collection time, we are finally ready to present this year's sort of results. This is from the year-end lending survey. And basically, I'll be going through the following 5 points. So I'll start with sort of general trends of the outstanding debt and what we've collected. We're looking at new origination volumes, general structure of loan books as always, and then we're going to get to the loan terms and pricing. So on the general sort of market debt that we're sort of collecting, so partially we collect obviously through the survey, and you can see here that all the banks the sort of included in the survey are on the first sort of light blue color, and then we have insurance companies, other non-bank lenders, and then I have included sort of CMBS that we add on from this time from the number provided from TREP. And I also add on the number here for annual accounts. These are people that are not directly reporting to us, where I use the disclosure, Pillar 3 disclosure reports that are public. And all together, and then we have an amount that's undrawn. Okay, so you can see here, we compare here the 2 years, 2015-16, and that's kind of roughly the same if you include the undrawn amount, but of course excluding the undrawn funds, because we don't know yet if they will be drawn or not. So the outstanding debt actually is like 1.5% less that we've been accounting for. And if we look at here, the next slide is what we really include in the survey. This includes all the people that report to us in the survey. Currently we have 77 lenders reporting to us. That accounts for a total of roughly 165 billion. The largest amount of that is like 127 billion from banks, and then we have 24 billion insurance companies and other non-bank lenders, 13 billion. That splits into junior, senior, and you can see clearly the largest amount of bond is senior, junior split, really 2%, only 2% of the total is currently held in like junior or mezzanine loans. And the other non-bank lenders are the largest group, and we will keep seeing that, and they have a split of 80-20 between senior and junior in their portfolio. So they are really clearly the largest providers currently for junior and mezz loans. The total origination, this shows you here the long history that you have certainly seen before. We had 44.5 billion new originations. This includes acquisition finance, refinance, and refinance loans. And you can see here, I mean, yes, the 2016 was a little bit lower compared to record year of 53.7 billion the previous year. I guess no one expected that to be reaching the same number, but I think comparatively we are still close to the 2014 value, so not really that far down. Overall, it's 17% lower than the sort of 2015, which was clearly quite an exceptional year. What is interesting here is we see that the UK banks and building societies, and we're going to probably hear more about that going on, they have sort of recovered clearly their share. That's due to a large amount of refinancing their sort of own loans or loans of other banks, but they haven't been there has been much less acquisition finance. And so they have clearly benefited from their sort of large relationships. The sort of North American banks here, which are the black color in the chart, you can see they were very strong in 2015. Clearly, they didn't do as much business in 2016. Really, market conditions were not quite right. They don't usually do the large portfolios that weren't really around to finance. They are looking for like 300, 500 million at a time. So their share has been a bit lower. And I guess also other international banks, the green bar has been slightly reduced. If we look at percentage-wise, yes, quite interesting between 2015 and 2016. Clearly, as I already mentioned, UK banks and building societies here, nearly half of the market they sort of originated. So they covered half. Insurance companies also kind of have seen a bit of decline in new origination. Again, maybe haven't really found the right deals and struggled a bit with their long-term financing that they're offering. So there has been a bit less. Otherwise, German banks pretty much kept their share, probably be a bit less busy and then got more busy in the second half of the year. But so overall, their share has kept stable. What type of sort of loans were originated? And we usually in the survey we have a question that where we distinguish between sort of investment loans, commercial development, which are speculative or pre-let. Here we have grouped them together, and then we have residential development, and other includes some smaller investment, but mostly residential sort of land without or with planning permission, but not yet coming under sort of development. So over the years, especially 2016, I think quite interesting to see that percentage-wise, the share of investment loans was actually significantly smaller than in the previous years. And we've seen a little expansion again on the residential development that wasn't as strong in 2015, and a little bit under other, again, usually that in the end ends up being development because it's still just land. So we've seen a bit of a pickup in that as well. So overall, quite a lot of, the share in total is still small, but we have definitely seen a bit of a pickup for interest in resi development and a little bit in commercial development as well. If we look at the split here, and we split it by the different banks, bank types, bank groups that we distinguish in the survey, we can actually look more into where does this type of finance sit, which group is actually active in what area of providing what type of finance. And I want to say it's really the very left and the very right, where you have the UK banks and the other non-bank lenders, which are mostly the debt funds, where the share of the investment loans is actually the lowest. So they have like 2/3 of their portfolios in investment loans, but then they have offered quite a substantial amount in residential development and a little bit in the commercial development section. So especially if you see activities of the other non-bank lenders, quite a lot of their funding went into resi development. If you look at commercial developments, you have a little bit here also done by the German banks, other international banks, and lately also some North American banks got some interest in that area, but clearly not doing very much. Insurance companies, mostly really 95% of their portfolio is investment loans, so I guess no surprise here. This slide here gives an overview of syndication. We always collect numbers and ask people to tell us also about syndicated amounts, which is club deals, participation, syndications, and to track that a little bit, I've put a little history over time. Again, not so unsurprising really that 2015 was again also a record year for syndications, right? Which it's typically also related to the fact that there was a lot of origination, there were a lot of things going on. So we see that there was quite a peak sort of from over the last really 8-9 years' time. That was also due to, again, American banks in 2015 being very active in that area, and it's type of their business model to be active in sort of doing syndications, etc. And again, that 2016, they were less present, so overall volumes dropped a little bit. A large amount of syndications were actually done now also by UK banks and building societies. They've been quite active in that segment, and we can also see that insurance companies also feature a little bit in that. Overall, though, volumes also equally a little bit down for 2016. It was difficult to, I guess, find the right deals, find the right price. So, but definitely still, I would say, an important market that has picked up since sort of 2011, 2012. Clearly one of the sort of exit strategies that lenders have been pursuing. If we look to lending sizes, and I put this in because it seems to be one of the slides that always came up in every presentation, so I've included that here. So we see, I mean, again, I don't think that shows a lot of surprising stuff. Clearly, we have a lot of lenders who are looking for the above 100 million deal pretty happily. As I said, this is based on 77 total lenders giving sort of their opinion on this, and biggest, I mean, the most common deal size is the most wanted, looked after deal size is the 20 to 100 million, so around the 50 million to 100, everyone is pretty happy with. You get to smaller size, you find definitely less lenders sort of lending in that lower segment. And then if we come to development facilities, again, I mean, I guess you find only of the 77 lenders in total, you find only a quarter or so that at all is maybe interested in development loans. So a lot less, but overall, throughout the ranges, I mean, you find from 5 million to above 100, you equally find people offering development, although a lot less lenders. Again, most favored segment is the 20 to like 100, most common. These are here other non-bank lenders, so I've just picked them as a separate segment. We currently have 25. And so I just wanted to show what they're doing. Are they significantly different? And I think actually, surprisingly, I expected more difference to the total sample, but I think they're not. Again, maybe they favor here mostly the maybe 10 to 50 million, yet though we have 9 who also go above the 100 million, so they have big platforms. So equally, they're looking actually for larger sizes, and probably equally not so many are interested in originating really small loans. And for development loans, the same. Maybe a little bit smaller size here, the sort of 10 to 20 million, but definitely you can find, again, maybe just a third of them offering any sort of development finance. Average loan size, so I put this one in just to, in generally speaking, show who's active in what segment and who's looking for what. And I think this makes it quite clear. This has been like pretty much for a long time been like this. You can see that the North American banks here are clearly the ones looking for the largest, sort of doing the largest sort of deals, and probably followed then by German banks, so pretty happy up to the 150 million, etc. And then sort of international banks and UK banks maybe slightly below the 100 million market on the average sort of usual. And then you have sort of other non-bank lenders that are within the sort of 50 to 100 million, but clearly on the sort of slightly smaller range. So next one, we just want to look at the total book overall. Again, I think that's a slide we've kind of always shown. This is about the sort of total book structure, what happened with the total outstanding loan amounts. So this is based now on the 165 billion outstanding. This was 2.1% lower than the year before. I just want to say to that number, because it's the sort of total outstanding book amount, it has been, of course, people have syndicated a couple of loans, so they reduced the total book amount, not because they originated a lot less. they have been all doing business, but there are this time a few that I had to now exclude because they had legacy books, and I moved the legacy books that we accounted for previously into what I've shown you before under sort of annual accounts statement, because they are not really active anymore, and I'm now only including the really active lender part here. If we break it down by banks, again, you can see here sort of UK banks and building societies. We've seen that already mid-year, sort of recovering and sort of at least stabilizing their sort of share. I mean, they've clearly brought it down, deleveraging the book, which we know, but I think it's sort of now finds a sort of level, which means they're sort of half of the market currently. And clearly what we didn't have before, other non-bank lenders equally taking their share getting close into the 10% sort of range. Loan-to-value exposures, what happened to that? I would say nothing so significant yet. I mean, we all know lending has been kind of at the lowest level ever. I think a lot of people are just looking for like sort of 50 loan-to-value range. I think we're seeing very close to what the REITs have been doing. They kind of have an average leverage of 30% now. So, I mean, the range of the sort of generally the loan books kind of show relatively low loan to values, and there's very little legacy loans now left. I mean, 3% of the loans are recorded above 100, which are mostly legacy loans. If we break that down again, I mean, that's a little bit more interesting, I find. You can clearly see which lender has the sort of highest loan-to-value exposure across their book. And you can see around the sort of international banks, North American, they have like 40% of the book is clearly into the sort of less than 50 loan-to-value range. But if you look at the other non-bank lenders here, again, the largest category here fits into the 50 to 70 loan-to-value range, which obviously includes the very popular 65 loan-to-value. So that's why that is clearly one of the most popular ranges. But you see in the yellow bar, they also have 21% of loans are actually between the 70 to 85, which is why they're offering, obviously we've seen before, they're offering most of the junior and mezzanine lending. So that's what that shows. Then what's coming up in terms of maturities? I think clearly, I mean, also for 2017, I would say there will be kind of ongoing origination and the pure refinancing amount due to the maturity profile that we see will keep sort of the normal deal volumes going. What's going to be maturing when we ask this question end of 2016. So the 18.5 million that you see, that is with one year, that would be the 2017 maturing value. Then in the 2 years, the 2018 column is a little bit lower. Again, that actually, if you look back at what happened in origination, and this was during the European crisis, right, in 2012, 2013, when actually volumes originated were very low, but that happens throughout capital markets. If you look at the stock market at the time, at the bond market at the time, the European crisis does show you it has a dip there. So that's exactly what the property market has done as well. So from those years, I mean, hence the 5-year typical range results in the fact that 2018, so the 2-year maturity is a little bit lower at the moment. Again, the 4-year is exactly all the volume that was originated in 2015, maturing in 4 years now. So you can see the peak there in 4-year maturities with 22 billion. But obviously that's going to be all rolling forward. Because it seemed to be that there was some interest in development this year particularly, I've included this chart here. Clearly in total we do, I mean it's still a very small amount, and that's why it's hard to spot, and I took it out of the total that we show, so to make sure to show you the cycle here. So clearly also we see the normal cycle, also the development loans show the cycle, and that we are definitely out of the dip there in 2013, 2012, and going up again, and we had 16 billion, we have 20 billion more, so that is already sort of a pickup in development finance there. This slide here, we show the regional exposures. I think what this also kind of shows, again, not so surprising if you know the investment market. Obviously, it's mostly always concentrated on London, which also has to do with the type of investors that are looking for properties, very international market. No one really likes to go much out of the region, so most of the activity concentrates on central London and southeast. So that's why also lenders, loan books mostly look like this. But I think there is a clear pickup over the past years towards sort of the central London area. It has to do a little bit with the type of buyers found in the market, and maybe the REITs and so on that are more in the regions have been actually net sellers. So the regional shares have been sort of declining. And if you look here at the green bar, that shows actually says other. This includes large portfolio deals. Again, they haven't been that many, so that number is slightly low. And we used to have, if you look at 2009, 2008, it was like 20%. There haven't been that many large sort of regionally dispersed portfolios around, so smaller share there as well. If you look in who holds what exposure and who is active in what regions, again, I would say it's split in a left and a right here. UK banks have the lowest share focusing on central London. They benefit from the regional network, from their sort of regional offices, and are sort of originating and doing, including a lot of their business comes from outside central London. And then we have the other non-bank lenders who probably focus especially on the rest of South East or outside M25 type area, right? Because often central London is now very occupied by the banks, also pricing-wise very competitive. So they might go a slightly bigger circle out there, also including sort of Midlands and North. If you look even the North American banks, and to some extent other international banks, they do show regional exposures. It's often though related to sort of portfolios. By property types, it simply reflects what the market is. I think this has been property types that has been very stable over time. You can see, I mean, the two largest segments are always office and retail, and then we get to all the other, and we're now excluding social housing, so that simply ends. So also the percentages have sort of rearranged itself a bit. What's maybe noticeable is that retail, a lot of comments were made, hasn't been that much in favor for lenders. I think because it's struggling a bit, the retail sector is changing with the whole e-commerce, online, etc. High street retail wasn't going very well. So I think that maybe has clearly reduced, because 2006, 2007, it was clearly still like closer to the 28-30% maybe. That's maybe something that has come down, where we can see a bit of a change. But other segments, I think, more or less sort of relatively stable market. Okay, so next section, I want to talk about the loan terms. I think hopefully that is everyone interested in knowing. Here I have picked out, not just showing you the average margin, because always the average covers a very large range. So I've picked out the 65 loan-to-value margins, because we have a lot of price quotes now that we can sort of segment that a little bit more. And I've split this here by the different types of lenders. Again, we can see margins in general have come down. I mean, again, during the European crisis, they were quite high. 2012 was a really high year. They have been going down. What we can see between 2015 and 2016, I mean, it's in particular probably the UK banks, so that were able to maybe take it down a little notch, while everyone else has obviously increased their margins and adjusted their margins slightly upwards during 2016. So while, I mean, German banks might have been sort of below the 150 basis point mark, they are now clearly above that. Some have clearly gone above the 200 basis point mark, but clearly trying to stay below the 250 mark, I think, especially for 65 loan to value. And of course, you can get cheaper margins for like 50 loan to value, so that there is a clear distinction in the end. Here, this shows you this is just the average margin, but for prime office, only, and it shows you average loan to value and average margin. For the loan to value, as I mentioned, it's very low at the moment. We have clearly fallen below the 60 level on average, so it's like 70, 57, 58 loan to value. Junior debt, also it's hovering around the sort of 70 to 75, and so these ones have been hovering around a bit, the junior and the mezz around the 80, 85, and the junior between 70 to 75 loan to value. Same for the margins. I mean, although I would say that on the mezzanine, again, 2015 seemed to be a very low number here. Then it went up a little bit, but it's clearly coming in at the sort of below 800 range in general. Here are sort of by property types. And we see here, again, I put the sort of 65 loan to value against the average. Because you see a lot of lending now that's even less than 65 loan to value, you can see that actually the average for prime office is lower than the 65 loan to value. On the arrangement fee, I think here we haven't talked about that one yet. Clearly, you can get something that is clearly below 100, around the 80, 90 basis points. For secondary, and that's where the distinction here happens, it's around 100. And also for alternative types like hotel and student housing. And the same happens a little bit for margin. I mean, while it's around the 200 mark for the prime stuff, you get to when you come to secondary property types, it's like 50, 60 basis points higher in general. Over time, I mean, yes, you can see the peak here from 2012 coming down and having, especially the prime side, having it adjusted a little bit upwards. While for secondary, that has actually remained stable. For developments, also for that, I want to show a few margins here. I think overall, development finance, what's interesting here is that it seems definitely it hasn't gone cheaper, especially 2016, while there was a little bit more interest in development finance from everyone, that it seemed to have gotten rather more expensive. But I think that also we can say that might have also something to do with different lenders offering that type of finance. While in 2011, 2012, there were still more sort of UK clearing banks involved, while a lot of it now is the other non-bank lenders. So it's just also the type of banks that are maybe now offering, or the type of lenders that are now offering that type of finance are naturally just more expensive. So in general, though, it hasn't come available very cheaply. This is here actually one of my last slides, and I wanted to make this point. I've included that slide here about relative value, because that's what, having been through some cycles now as well, I found quite interesting, because whenever lending becomes a problem, we have very low loan to values, but what we see here, we have put property years, and property years are now extremely, especially for prime properties, goes below the 4%, 3.5%, etc. And so it becomes really difficult to even put more there. I mean, you really can hardly put more than 50% loan to value on a prime property. It's because if you look at where actually the sort of margin plus LIBOR rate and plus fixed rate, so the blue line that hovers a little bit around, this is actually the 5-year fixed rate. So this is what the borrower actually is paying. And you can see during 2013-14, that was actually already higher than the prime property yield in the West End. So it's very hard then to make a deal work. And the best time to actually get a fixed 5-year rate was actually mid-year last year, July, August, because that's when the two were very much together. And what that means is really, it's not, the squeeze doesn't come from the loan to value, but comes more from the ICR, I believe, in the future. And I've put here together a little illustration, which is a typical loan to value, sort of 60% loan to value deal. So for a prime property with 3.5 sort of net, this is a net yield here, actually. You pay currently, if you put the sort of 5-year fixed plus margin, you're at your like 3%. You still get an ICR cover that a lot of people report just below the 2, so 1.9, etc. And everyone, I think, felt like over the past years, ICR covenants have become a bit irrelevant because everyone was getting like 2.5, 3, 4 times. And I think this is we're getting more into the area again where you have to keep watching it, because now it goes below 2, and once interest rates just going to rise 100 basis points, you can pretty quickly, it's going to go to 1.2, and that's where your covenant sits. And actually, once we raise the overall rate to like 6 on a 60 loan to value deal, we're actually going to have a default because it goes below 1. So that's the one point I generally wanted to make, what I think we are seeing in the market. So my conclusions for today, obviously we've seen loan origination volumes a little bit down, but a lot of refinancing and so on, and the constant maturing loans will keep up the sort of volume which are sort of enough to keep the market going. I think we clearly see an extended property cycle with very low interest rates, but as I said, I think sort of ICR covenants have to be watched, and where interest rates are going, especially sort of the 5-year sort of fixed rate, because it has already at some point gone up. So I think next problem is not so much the loan to value, but once that happens, the loan to value ratios will move out as well consequently afterwards. The other thing that we've seen, and I've put more breakdowns this time in terms of which lender is doing what, and there has been clearly a specialization in different lender types. The insurance companies doing specific type of business, and other non-bank lenders concentrating like development or junior, etc. Yeah, so I think there is a higher specialization these days in the market. Maybe the diversity doesn't benefit everyone, but it's more niche type specialist lending. I want to say many thanks to all the people that make all the effort supplying all the data and getting chased by me. Because we clearly ask a lot of information, so many thanks for making the effort to supply and make this study possible. Also many thanks to all the sponsors of the study, that again, otherwise without these people it wouldn't be possible to keep publishing the research. And with that, I actually hand over to our next part of the evening, we have our panel discussion. And I guess if there's questions, I'm happy to take a few now, and otherwise we leave that also for the panel to sort of evolve naturally. Okay, so Mark, I guess.
Okay. Thank you, Nicole. Actually, before I asked the panel to come up, I had planned on saying a lot of really nice things about you in the report, but that was before I knew that Bill Maxted was going to be here, and I realize now that anything I say about you, he's going to get all upset with. So it said here, was an interesting, insightful, best report ever.
Can't say that.
So if you could just bear with me, it was okay. But if the panelists could come on up and sit where they choose, I know you all, I'll be able to find you. I'll introduce you as you're coming up. I don't need to introduce myself, it's all up there. Actually, I don't need to introduce the rest of you either, but when you take your places, I will then say who everybody is, though I suspect you're all well known. And Nicole, I got actually one last comment for you as I went through the report one last time on the tube coming over here. And I know we struggled to agree what my speaking fee would be for this event, but I want you to know that I've decided I'm willing to waive my speaking fee in its entirety. I just want one small favor. I'd like you to introduce me to the person who provided this comment to the report. We don't require our borrowers to use any hedging strategy. If you could introduce me to that person, that would be great. Okay, so someone's going to tell me I have to turn my BlackBerry off so this doesn't, and yes, I still have a BlackBerry. So introducing from left to right, hang on, Amy Asnar, Michael Kenny, Emma Hupfley, Paul Coates, Cameron Spry. What I'm going to do in terms of organizing the questions, and we've got, I guess, about 45 minutes, and I believe me, I've got enough questions to keep us all busy here for the next 45 minutes. This is a short session for me. My lectures at Cambridge are normally about 2 hours. Those of you who've been to the bank session know they're 3 hours, so I never struggle finding something to say. I think it'll be kind of interesting, and I'll be more confident that I'm addressing the topics that you'd want to hear if you guys interrupt with questions. A couple of you I bumped into during the drinks beforehand, and I said I'd call you out and see if you've got something to say. I was about to say I won't do that. I probably won't do that. But I think it would be more interactive if, as you're listening to what's being said up here, you hear something either you don't agree with or you'd like to hear more about, or there's something we're not talking about that you'd like us to talk about, just let us know. In terms of how I want to organize this, what I really want to do is spend the first part of the session really looking back at the report. I had the advantage of being able to read the report, as of course, have the panelists, and to reflect a little bit on 2016. But I think, if I may, one of the most interesting things we could do is, in fact, take that and take the first quarter, what we already know, and start trying to project as to what the today looks like and what how the rest of the year might play out. But I'll start with an easy question. This is a one-word answer question. You only get one word. We can deal with the color on it in a little while. My first question is, in the equity world, we talk about buyers and sellers markets. Buyer's market or seller's market. Cameron will know this terminology easily. Would each of you characterize 2006 as having been a borrower's or a lender's market?
6 or 16?
Oh, excuse me. Nobody's as old as you and me.
We're going to go through every year, are we?
I'm really testing your recall. 2016, borrowers or lender's market. We'll take it from left to right, my left to right.
Lender.
Mixed.
Oh.
Wait, you're not allowed to do that, are you?
One word.
Okay, I would say lender.
I told you I didn't understand the question because every deal's got one of each.
But I explained it better now.
Lender looking at the statistics.
I think it's a lender's market, 2016.
Not a consensus, not a consensus. Well, let me start, as I review the report from this year, let me start with who was actually doing the lending in 2016. So as Nicole pointed out, the market share last year, shifted quite dramatically from prior years. And for many, many years, since even before the financial crisis, the UK banks and building societies had been kind of hemorrhaging market share. And they saw their market share jump from 34 to 47% this year. And I think it's the shift in who booked business last year may have something to do with this whole issue of how the stats were moving around. The overall lending was down. What was it? 17% was the number. But actually refinancing was up 15%. So if you really split it between refinancing and new business, there was a significant jump in refinancings. And in fact, refinancings of your own books, rather than stealing business from one of your competitors, was up 50%. So given that last year was all about refinancings, which perhaps isn't surprising because we didn't have an awful lot of deal volume for those of us on the equity side of the business, it shouldn't be a surprise perhaps that the UK banks were big winners. And there was a comment in the report that you made, Nicole, that quote, the large existing customer base, referring to the UK banks, provides a constant flow of refinancing volume. But my question on that is, should we look at 2016 as some kind of a short-term distorted environment, or perhaps when you were talking about the overall loan book size having stabilized for a couple of years, does this signal a reversal of the trend of the declining market share amongst the UK banks? And my second question is one that I suspect you'd less like me to ask, is if there's this huge imperative to keep hold of your existing loan book, your existing clients, and let's face it, for the first quarter of 2017, transaction volumes are further down on 16 than 16 was down on 15. So we haven't gotten out of this yet. If there's this huge imperative to keep business, does that mean that on this question of is it a borrower's or a lender's market, we should assume that if we're not already in a borrower's market, we're going to be in one pretty soon because everybody's going to be keen to keep whatever business they've got? I guess I'll start with the UK bank since I've invoked your name.
I think it's interesting.
Question to simplify.
I think that was an answer as well.
Oh, thank you.
Was the change in market share last year a one-off, or is it the shift of the trend?
So I think
And because of, I've got to finish repeating the question for me. And because there's this competitive pressure to keep business in a low transaction environment, is that a leading indicator that we can expect to see pricing fall, more competition?
so. What Nicole didn't put in the slides, but is in the body of the report, is that 80% of the banks are looking to grow their loan book this year. Put that statistic against a backdrop of a slower investment market, which is all the sort of consensus forecast for this year. I think that poses an interesting question about how do you do that. I probably don't read quite as much, Mark, into the sort of shift in the UK banks' market share and the amount of refinancing. I think that's just a function of where we are in the external market. So, you know, there's a load of money looking for property, there's a load of money looking for yield. There's a lot of people just sitting on assets and holding them for return. And I think often as the incumbent lender, it's easier for a borrower to sort of maintain the status quo unless there's a very compelling reason, whether it's margin, whether it's cost, whether it's aggravation, to move than to leave it where it is. So I think it will probably just be a function of the wider investment market. I wouldn't be surprised if you see similar stats in 17, things staying where they are, lots of refinancing activity, rather than a lot of trading activity.
Emma, you're in the middle of a lot of deals, right? How would you read the same set of statistics, the same data set?
Well, I think we saw a very distorted market last year, and so there was 6 months of very little acquisition activity to fund, and even when things got going in Q4, a lot of the bigger deals stayed out of the UK debt market. They were either all equity or they were funded by overseas banks out of the UK market. So it was very, very distorted, and that meant that lenders looking for things to do naturally sought any opportunity through refinancing that was available to them, and obviously that favoured those lenders that were incumbent and had big books to go at. I think that, you know, does that mean that borrowers are in a very good environment? Does that favour borrowers in terms of what they can achieve through refinancing? I think that you know, they are in a good position if their relationship with the lender is good to build upon that and know that in a very competitive environment, lenders would rather build on existing relationships than perhaps have to go and replace those loans out in the market and bid against 10 or 20 others for every opportunity. So I think as a borrower, you should consider your loan asset very valuable to your lender, but at the same time, I think if you went to try and extract a load more equity out of those deals, you probably get short shrift, but you might be in a good position to negotiate a better margin or more flexible terms.
Good news for us on the Let me talk for a minute about development, some of the kind of cross currents in the figures. Investment lending was down more than development lending, and lending for residential development was an area of strength within kind of a weak general volume market. Some of your comments on spec development, commercial development lending, where this is not a place where anybody particularly wants to go. And I saw a piece that Richard Dakin, who used to have Paul's job over at Lloyd's, wrote a couple of months ago, who wrote in the States Gazette that spec development finance is, quote, scarcer now than ever before and a threat to regional markets in the wider economy, blaming the slotting regime in Basel IV, which I'm very familiar with from my Bank of England work. And then the margins you showed really blew out, apparently, in 2016. And what I'd like to hear from the panel is, did those figures make sense to you? Is that what you're seeing, those of you who are actually working in the development sector, considering development? And the other question I'd like you to comment on in particular is if you're engaged in it, what is the difference between London and the regions? If you could just at least make sure that in framing your response, you keep it on both sides. Michael, you want to give
Yeah, I'm happy to speak to the development aspect. I would only comment, though, on commercial, not residential. It's not something we really get involved in. I think the point about the spec market in particular is it's all about level. I had a conversation a long time ago with our Chief Risk Officer, who, at the time that we went through the global financial crisis, said there is no such thing as a good spec development loan. And so we had this sort of game of, well, would you lend me £1? Well, yeah, I'd lend you £1. And so you get to a level with spec development finance where if everybody's at it, you start to get pricing creep, and I mean by pricing creep in that sense the wider whole set of terms that goes into making a spec development loan.
I have to interrupt you for saying that, Michael, because the truth is, if you look at Basel IV, it doesn't actually distinguish on LTV on spec development loans. It effectively blanket says it's bad. This is a massive capital charge against it. It was shocking to me when I had to go to Basel and give testimony and all this stuff that they really are completely indiscriminate, at least from the capital charge side, the risk-weighted asset side in commercial versus residential.
Right, but every bank's P&L has got a whole blend of factors in it which contribute to the year's results, and therefore, if you can put loans onto your book which bring in significantly more income than others, you can balance out the low remuneration aspects, and that's why some lenders will choose to do a certain amount of spec development. I think the point about many aspects, what we'll talk about tonight, is the supply and demand of the market. If there are few providers of something like commercial spec development, then you get more chance to say the terms on which you're prepared to do it, to find a risk framework that works for you, and then, aside of the Basel IV comments, you provide a diversity of income across your book, you build relationships with certain clients, and in a good space, the spec development gets let up, and then you hang on to the loan asset there afterwards, possibly with a sort of top-up of refi. So I think a lot of banks were scared off and chose not to go into that market at all. We as a house did a certain amount of it because we were in that position where there weren't that many providers. And I think that has continued to be the case, possibly a little bit drift off post-Brexit for reasons which may be obvious and we may talk about further. But I think there is space in that market for lenders to have differential lending product and therefore to participate in that market.
Michael,
We don't really do, so I would sort of pass that on to...
Just jumping in from a borrower's perspective, I think that sounds reasonable and great, and that there's a whole metric around how risk works and so on and so forth. I think the reality that we find, we do a lot of development both here and in Europe. We have been probably moderately successful in our borrowing around it. It's binary. Banks are either willing to do it. If they are willing to do it, there's not much pricing of risk, or they're not willing to do it. And I think that it always surprises me, and it always, actually, Amy, I'm sure you'll comment, it always surprises me that the debt funds don't really step into it either, because to me it's an ideal product where you can generate those kind of returns that they promise investors, and skeptically I doubt they deliver, where you can be senior in the capital structure, you can set your own terms, you can price risk, all of those things that they advertise. Yet it's very, very rare to find one that will do it, and I think it's very rare to find a bank who'll do it, and when you do find a bank who'll do it, it's not very dynamically priced.
Amy, you
Cameron, just to respond to that, I think the point about the bank-provided spec development finance is it's tended to have to find a competitive advantage to win that business, which is possibly therefore lower pricing. The growth in the share of non-bank lenders in providing finance generally, and I think at this point, I've had one of the slides, shows that that gap to some extent was filled by non-bank lenders where banks weren't doing it. I think more of the issue historically for developers has been that they couldn't bridge the cash gap to fund all the costs necessary to complete the scheme, and that's what stopped it. Whereas we've seen in general terms in the lending market much lower loan to values now than we had 10, 15 years ago. There is more cash, there is more equity available, and so the ability to borrow, shall we say, 50% loan to cost, or even slightly less than that, to get the deal through with some debt on it at whatever the coupon happens to be, but an awful lot less than the cost of equity, means it's worth doing.
Yeah, I mean, I guess from our side of things, we selectively will do commercial development, and I think you're right. I think when we do like something, there's usually not too much competition. So it's an interesting space, but we're quite choosy there. Where we are very active is the residential development side, and we've invested about £500 million over the last 5 years in that space. And it was interesting to see Nicole's charts up there in terms of margins punching out a bit last year. I mean, we did experience the same thing, actually. We thought the residential lending space had become much more competitive in 2015, but in 2016 we noticed actually a lot of people pulled back from the market, particularly on larger size. So anything that was sort of north of 50 million, we found sort of a dearth of competition. So I would say we would agree with sort of what Nicole has shown on the resi side, and we're very, very active on that side of things.
Mark, just one thing not maybe mentioned on the commercial side would be the impact of institutions and forward funding. So often where we see commercial investment speculatively that we would be prepared to finance. In a search for assets, some of the institutional funds will come in and forward fund it at very attractive prices to secure the end asset. Clearly won't come through in those numbers. But
Yeah, and sometimes that's our competition, actually.
Let me ask what has to be an obligatory Brexit question, and I promise it's the only one I've got on the list here, which is, has anyone observed or does anyone anticipate an impact from the triggering of Article 50 on participation in the UK lending market, particularly by non-UK lenders, or the behavior of the UK lenders for that matter? And frankly, has anyone post-June 23rd, which most people think of as significant because of the referendum, I just want you to all know the real significance is it's my wedding anniversary. If you've really seen any effect post-Brexit at all?
Well, let me talk about sort of the investment market, and I did notice a lot of the bank discussion around volumes really is a function of what's going on in the market. And at Tristan, we're in a small and somewhat inconsequential part of the overall market.
You're big, that's why you're here.
But thank you, Mark. I think that post the referendum, and I think to some extent, the political issues that we're still dealing with, have widened out the bid-offer spread and pricing of assets, and I think that has effectively ground the market or it's lowered volumes in the market, and I think that's continuing. I think the reaction of investors has been to do, and it's been very easy for people to do nothing and explain it as a transitory process. I think that's starting to change now, and I think people are starting to look at what's going on with the election and so on and so forth, and look forward and say, okay, well, this is going to be a permanent state of somewhat of discussion. It looks like the Brexit process is going to be a longer process than these 2 years, and I think there is starting to be a narrowing up of that bid-offer spread. But I think that foreign investors or foreign lenders, I think are slowly getting comfortable with that.
Michael, you want to just speak on behalf of...
Yeah, as a German bank, we're right in the middle of this, trying to work out with everybody else exactly what form Brexit will take. our board came out quite quickly with a statement to those in the London branch saying, actually, we remain entirely supportive of continuing our business. The UK is the most important overseas market for banks, and many banks like us in London. That's why we will start off in London as our sort of European base. I think the reality is that until we understand exactly what the implications are, that the intention is to keep calm and carry on. I mean, we will remember 2016 for the obvious decision and the fact that the economy didn't suddenly fall into a hole as many people had predicted. But as has been pointed out by many commentators, and just to remind ourselves, it only happened last month. We actually pressed the button, and indeed it remains to be seen. I've heard one or two express the view that politically never rule anything out if they don't get a decent deal, and we go back to say, please, sir, can we perhaps stay in? Is a scenario which merits a bit of thought. I think that how the financial flows are then regulated in future, and whether banks can collect their interest gross in every market without the requisite passports, or whether you need, or whether you've applied for one of the 13 passports that exist. I think that's the right number that have been declared. All remains open for discussion.
Okay. Paul, you just threw out a stat a moment ago that I want to actually come back to. This 80% of lenders who think that in 2017 they're going to increase their loan volume. Now, we know that loan volume shrank from 15 to 16 to a great extent mirroring the downturn in the transactional markets. We know that the transactional markets are still falling. This is not a question necessarily for you, Paul, it's for the panel, okay? I'm struggling with this issue. There's just not enough food to feed everybody. So can somebody have the courage to give us a view as to what 17 looks like from a deal activity perspective, and particularly not in individual institutions, but are some groups better positioned than others, and beyond just the refinancing question, but really looking at new business? Who wins, who loses?
Well, I have a go at that. I think that, we all have to go to work optimistic each day, and we all have to go with the intention of trying to do more business. But I think if that question had been posed slightly differently, are you prepared to take a 10% drop in your return in order to maintain your business or to grow your business? Or are you prepared to do another 5 or 10% on the leverage point in order to win business? I don't think lenders would necessarily be prepared to do what it takes actually to keep growing market share in quite a challenging environment. And going back to the Brexit point, I think that the one sort of lasting effect that we saw from looking across the market was that a lot of lenders just went risk off and everything went further back. So senior lending seemed to cut off at a slightly lower point. Alternative lenders were just a little bit more cautious about how they underwrote debt yields. So I think everybody goes into 2017 wanting to do business, but not really being prepared to take an awful lot of extra risk in order to do that. On the other hand, I think if you are representing a source of capital which is able to look carefully but flexibly at the market opportunities and see where, for whatever reason, debt availability is thin, and to move into that area. I noted that only 4% of funding is directed at Scotland at the moment, and only, I think it was 11% or 12% of total lending was done in the north, whereas London and the southeast was taking 64%. Well, that's an obvious opportunity, but it doesn't suit everybody to go outside the southeast to go and grab it. So I think that's sort of my answer.
I may actually transition that one to you, Amy, because you raised the point of the he who or she who is flexible, right, may be the one who gets the opportunity. And I looked at a study in whatever Jane Roberts' new publication is called, this week's title, that said that since the financial crisis, well more than half of the new market entrants in the senior space have been debt funds. And I took down a quote, Amy, that you gave in IPE Real Estate, where you said, institutional investors increasingly see real estate debt as an investment strategy which can offer downside protection whilst generating attractive current yields and risk-adjusted return. So I did some math, and what I figured out is if I want to go out and buy a portfolio of single A, triple B bonds, I'm getting 1.5. If I lend them senior debt, I'm getting 3%, and presumably you're doing some things to juice that return. Is that really what's driving it in terms of the money coming into the sector, into your funds, funds like yours, which may have started as mezz pushing deeper and deeper into the senior space? Is that a trend that's going to run and run and run, and are you going to be an increasing threat in 2017 in a volume-challenged market to everyone who's kind of down the panel on the left to you?
Well, I mean, first of all, we don't do that much vanilla senior ourselves, so I think we're not a threat. We're still a partner, guys. But to your question, I mean, so first of all, a lot of our investors think about their real estate debt allocation. Some of them take it from their fixed income bucket, and then they would very much be looking at it the way that you say, as an ARB over corporate bonds.
Right.
A lot of my investors in the mezzanine debt space are looking not only from their fixed income buckets, but also from their real estate buckets. And they're saying, okay, this is a great complement to my direct strategy. Okay, the direct market is forecasted unlevered to do like 3.9% over the next 5 years. Okay, this is quite an interesting, high yielding strategy in that kind of alternative investment if I'm looking at my direct side. So I think alternative to direct property, complementary to their portfolio, and an alternative to fixed income is kind of how they think about it.
You reacted when we had our little conversation a couple of days ago to one stat or one comment that came out of the report. I'm going to go to that now, which was, quote, "There is little requirement for junior and mezzanine lending." And we
I disagreed with that one.
The number showed that junior mezz finance was down 25%. There was a sharp erosion in margins. Can you give us your thought on that?
Yeah, I mean,
what are you seeing?
Well, so what we're seeing is pretty stable margins over the past couple of years. I would say the past kind of 2 to 3 years, the margins have been pretty stable. I find the little requirement for mezz surprising because at the same time the report says that senior LTVs are down and south of 60%. So in that sort of environment, mezz is even more required, particularly if people need to refi and they don't want to put in more money, et cetera. So we're still seeing, we've done 50 mezz deals. I mean, so I think for us, because of the way we approach the market and with senior partners, we see a lot. So I would definitely take issue with the report saying mezz margins are down, whatever it was, 150 bips plus over the last year. We haven't seen that.
That's why I wanted to ask the question, because sometimes you don't know that you get a full, who responds, and I know it gets better and better every year, but that's why it's useful to have this conversation. I mean, Karen, you're working up at, you're watching your capital structure to optimize your equity returns. Any thoughts on that?
Yeah, we've not traditionally been a large mezz borrower. Not to say we wouldn't, but the rate of return that we're looking for on our equity and the rate of return and the pricing of senior leverage is so attractive. I think mezzanine is that point at which it starts to become unattractive for us on a risk-adjusted basis. And I think when you look at it across a portfolio, you introduce a whole different sort of risk position once you start levering things up to a high level. We've used it in a couple of occasions when we've refied a loan that hasn't, a loan or an asset in our case that hasn't performed, or we haven't wanted to stick in equity, or we haven't had equity to stick in.
Sounds like a great deal. Don't quote me on that one.
Yeah, I think we probably did call you. But those are so rare that they.
He only does the good ones. She leaves the bad ones for someone else.
It's so rare we have one of those. But the situations that we have looked at mezzanine and the pricing to me has been pretty consistent across the piece. The only other area I think that what we do see is a lot of people now trying to provide larger whole loans and bifurcating that into mezzanine behind. So I think from a borrower's perspective, sometimes you're aware of it conceptually, but you don't know exactly how it's being tranched out.
Yeah, and I would say that for us is an increasing trend because the borrowers do want simplicity and they want to see a whole loan at 75 at whatever, make it up 325, 350 over, and that's it. And then if we tranche it, they don't mind. It's just simple for them. So I think that is increasingly in demand.
Our experience, particularly with some of the US banks, the larger investment banks that are providing big whole loans into situations, I think some of those, the top end of that is going into the MES market. And I think when you sort of break back the pricing, I think you can see that those margins are still there.
There's a couple of things going on. I'm surrounded by two opportunity funds, so I've got to be a bit careful. But you guys have got capital to deploy. The investment market is slower, there's less opportunities. Actually, taking your capital strip down to a very low number sort of doesn't help your investment strategy. So there's a sort of borrower demand kind of playing into that kind of equation.
I think it's a good point. I mean, you've got, and actually, Mark, it takes me to another point, which you made just about, 2017, what's the market going to look like? I think the one thing that, many people who aren't in the raising closed-end fund business don't appreciate is you raise these closed-end funds, they have a investment period. Generally, those investment periods are for 3 years. So to some extent, you can look at when all the money got raised and take out forward 3 years, and all the money has to either be spent or invested or given back.
Can you give me examples of anyone ever giving the money back?
Right. None of us like the
Maybe
give
I'm too
back
young,
process. So I think you can, this concept of dry powder or uninvested commitments, it exists for a period and then it falls away. And I think some of the feedback we're getting from our LPs, particularly the ones in the US, is they're starting to see not just in real estate but in general private equity, and a lot of us get bundled into a wider alternatives bucket, that there is a lot of uninvested capital, and people, and those that have invested the capital when they go back are having to discuss the whole issue of uninvested capital, which didn't exist. I think that discussion just didn't come up a year or 2 years ago. So I think there will be pressure on people to invest that capital over the next 18 months, 2 years, because I think a lot of it's been raised. People don't like to return it. The observation I made before about the market feeling a bit more like there's a bit more activity in it, certainly in terms of some of the initial stuff we've seen. I think you will start to see more primary, I think you guys call it primary flow of opportunity.
But Cameron, come back to a point you made there, this whole implication of whether there's enough business around for everyone to do, in a funny sort of way, has a knock-on effect on business of people doing junior debt, which is if the appetite of investors to use lower leverage is generally sustained, what we need you to do is to find the deals. What seems to be missing a bit at the moment is the deals. So from Paul's point of view, from my point of view, therefore, the deals that come out of the market in the form of refi. Refis are not easier in a market where interest rates haven't actually moved up at all, where the business plan maybe was a little bit slower being delivered than perhaps it might have been, and therefore you're pretty much in the same zone as you were. Bit of a chance of a reprice, not even necessarily a requirement for a cash out, but hey, that would help as well. And all of a sudden it becomes a natural feeder for the lenders who otherwise aren't finding the transactional volumes to support. I mean, it seemed to me from some of the slides, and I haven't memorised any of them actually, there were so many, that the non-bank lenders in particular were going into the niche areas where there's higher pricing perhaps, alternative types of property, the harder bits of development lending, and that in itself is where they're growing their business. Not necessarily at the expense of, if you like, the normal senior debt lenders, as I would characterise Paul's and our business.
I don't think we're growing in such funky niche areas, and we also like those sometimes too, but we also like the very vanilla investment stuff, but then we would be partnering with you. We wouldn't be wanting his piece. And yeah, you guys like 60% debt, but it's also a bit about what returns you're targeting, right? If you're targeting 20%, high teens, 20 plus, it's quite hard to get those in today's market if you're only at 60. Maybe you guys can, but most people would want 70, 75% debt. And if you can lock that in for 5 years at 4%, that's going to be accretive. So
Yeah, I mean, it's also
375, whatever. Yeah.
How things.
Let me say, I'm not seeing a lot of hands going up out there, so I'm just going to forewarn everybody. We're not going to have at the end. I'm not going to ask for questions, and then we're going to have that awkward pause. We're going to dispense with that. So if you've got questions, ask them as we're going along. If I don't see a hand come up, I'll assume that we're doing a good job up here, and we'll plow on. My next question is another one that I put under the obligatory questions list because I'm a non-believer and I'd have preferred not to ask it. CMBS. Going nowhere, at least seems to me. I looked at the numbers, the cumulative issue volume from 2008 to 2016 was less than in 2005. And much of that paper, as we all know, was kind of special circumstances. I want to post it with the Bank of England and be able to get some cheap money or what have you. The question I would ask is that the broader asset-backed markets are actually pretty healthy. So what's the issue here, and are we safe to actually ignore CMBS for another year?
I'll start if you like, because I think it's I'm going to broaden your question. I'll play your game and ask a bigger question.
But I don't have to answer. I'm the moderator.
So the distribution of debt, which slide went up, was 14 billion. Actually, within that, 10 billion is club deals. So they're your larger corporate type transactions. So 4 billion of syndication and origination last year of 44, so 10%. So why is that? So you've got a huge weight of money seeking indirect investment through some kind of debt instrument, and yet the primary supply is not satisfying that demand. So it's a question, not a kind of conclusion I'm drawing, but why is it, if there is this investor base that would be very attracted to a debt instrument, you can call it CMBS, you can call it a bond, you can call it a loan, that's just the vehicle. Why have the two markets not worked closer together? And maybe it's this 80% want to grow their loan book, so they're not really interested in distribution in a broader sense. So I think it's you look at the US market, much more sort of liquid flow into secondary buyers from primary origination.
Emma, you must have a view, because the one note from our email exchanges that I actually wrote down here was, you said, quote, there are more debt investors seeking access to syndications than there are platforms for fulfilling that purpose efficiently.
Yeah, I think I qualify that actually.
I would cut that bit out.
I'll just amend my own quote if that's right. I think it's actually not a lack of platforms ready to offer the product, but a lack of suitable product for all the debt investors that are out there looking for something that matches some very specific requirements. So it may either be yield targets and which are wrapped around a certain investment types, which don't allow those investors to go and invest outside London, but in fact to get the sort of yield they're looking for, they might have to. So it could be that sort of restriction. And I suppose then you've got the sort of investors that want bond proxy type, very, very core senior loans, and we've seen those being snapped up by a much, much bigger spread of different overseas banks recently. And I think if that product could be supplied in 5 times as much scale, I think there would be take-up of that. I'm going to try and do a bit of audience participation and ask Clive to comment about CMBS, because we were having a bit of an email exchange today about regulatory capital costs and CMBS. So would you mind, Clive, giving a comment about your view on the CMBS market?
Coming over this way, so. I promised I wouldn't do that, but I didn't promise that.
No, I mean, I think the problem with CMBS all along in Europe, certainly compared with the States, has been bank pricing of risk, which is substantially, they price it a lot cheaper than the capital markets do. And so it's hard to get a significant flow of bank originations or lender originations in general to flow into the capital markets. And sometimes it works. And, 2007, a lot of strange things were happening across every asset class in every jurisdiction. So that included Europe, and it included commercial mortgages and CMBS. But if you take that year out, it's always been a tough struggle. And I think now when origination volumes are low, banks are hungry for any kind of yielding asset. There's just not a lot of activity, and even in the ABS market, I mean, a very significant fraction of that is held on balance sheet and repo. Although the overall volume's quite high, it's not getting out there into the public. So,
just an additional thought, actually, and that's something that's come out in the last few years, which is, and as a balance sheet lender, I would say this. And despite the disintermediation that arises to some extent from the introduction of debt, as I sit opposite Ian Marcus down here, but the aspect of CMBS which sometimes gets lost in discussion is that if you know who you're borrowing from and you can go and talk to those people and you can deal with the issues that arise, unless you're at a level of debt which is so no-brainer that a servicer is simply, and it's in the AAA space, that it really is just a complete no-brainer. My sense is that the product lost a lot of credibility when people realised that a whole range of people out there had different voting tranches, different rights. You couldn't actually go and talk to anybody and resolve a problem as you need to, which actually is in my view, a great strength of the balance sheet loan. I mean, we get resistance from clients sometimes to even syndicating or bringing in other participants in some of the loans that are maybe a bit bigger for our balance sheet. Now, in a world which is full of threats of artificial intelligence and robotics and other things that are going to do us out of a job in a few years' time, by which time I hope I'll be retired, I feel there is still an underrating of the ability to go and see somebody, talk to them, present a product, talk about the fact you've been trading in the UK for a gazillion years, or 25 in our case, and that ability to talk is very valuable when things don't quite go according to plan. And I think that is certainly in support of the balance sheet lenders.
Well, and I agree with you. And that's not just the case on CMBS. It's also a lot of the lenders who are quite competitive today are selling down basically all of it. And I'm always amazed that the borrowers, a lot of the borrowers, some do, some really do, but some don't differentiate. They don't actually say, I don't know who my lender's going to be down the road. And I tell you, if something comes up that's either an opportunity or a problem, I think a lot of borrowers will find it's helpful to have somebody to go talk to who holds the risk. So.
Yeah, I mean, I was
You're listening to this.
listening
I got
to
a
this.
reaction.
You know, I think the CMBS, the unwinding of the CMBS market, 2008, 2009, was so chaotic, where the quality of documentation was so poor. So many. It was such a new. It was an American technology sort of brought over here and left to run wild. And I think borrowers, are much more focused on, who they borrow from, because for the obvious comments that have just been made, you set these covenants and you're investing for 3, 4, 5 years out in the future. You set covenants that you run your models and whatever else. But we all know that some of these times you get into things, events happen that mean that you have to sit down. And in most cases, actually, when you have a bilateral relationship with a lender, and when these are extraneous events, there is a sort of a sense of partnership around it, because in most cases the banks don't want the problem themselves anyway. I think the CMBS market proved it didn't really perform well in that, and through those circumstances. So I think, as an industry, we are much more focused on it. I also think that actually, if you look at some of the problems in 2005 through 2007, a lot of them, to some extent, were formed out of almost the democratization of debt, where anybody could get effectively the same terms, and the debt market or the CMBS market was sort of totally agnostic to who the borrower was, what their ability to perform in
What the quality of the credit was.
And so you had all these people coming into the industry who effectively could raise the same financing, they could put the same capital structures, they had their own views on what pricing should be, and the whole thing just got swept up. And I think the fact that actually debt is much more now a bilateral product, and lenders are a lot more focused on who the sponsor is a positive thing for the market.
And I think that the cost of capital varies by sponsor, and there is, I suppose, an inequality, whether that's possibly a good thing, in that better sponsors can achieve funding at much more competitive levels at the moment in the market, and there are real barriers to entry for somebody without a track record, which is possibly.
It's an interesting question, therefore, whether, as memories fade, people like Michael and I retire.
You'll have to fight your way in, Peter. Right?
Will borrowers maintain that value in the relationship, or will they chase the highest leverage at the lowest price to make a return kind of work? So my slightly tongue-in-cheek comment about borrowers and lenders.
I'm encouraged by the fact that Michael's worried about artificial intelligence, which I am too, but I'm going to retire before then. And a young guy like Cameron is talking about the importance of bilateral relationships. So I think we are safe. We can work a little bit longer. Peter.
It's all relative.
So the risk of extending the CMBS debate, which I think has probably had more airtime than it deserves as a product at the moment. But just picking up what I think Paul was perhaps hinting at earlier, which is that I think there is a problem in a market where few lenders are interested in doing the smaller ticket and regional lending, and the only available distribution channel that we're really seeing a lot of in the market is syndication, which doesn't really work that well for smaller ticket stuff. So to the extent that there were appetite in the investing market among non-originating capital providers for the risk and return of a diversified portfolio, such as might have found its way into a conduit CMBS in the old days, had those deals been structured properly, made available in the right way, blah, 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 all that stuff. The market is missing the instrument that can allow the connection to be made to the market, to the borrowing market.
Well, that, and that was going to be my next question. We're going to put my Bank of England hat on for a minute, actually, was this notion of what's going on in the regions. Because the data showed we're up from 25 to 50%, lending into London. And what I'd point out, and this is really a challenge almost to the lenders, Dom Smith from CBRE does this good debt research, and it's pretty analytical. And in his most recent report, he pegged the risk-adjusted return on senior lending for what he calls rest of UK offices to be 100 to 150 basis points above London offices. The question is, as I guess it's as Peter's saying, are lenders missing an opportunity, or because I really don't want to dwell on it for too long, is it the distribution system problem?
So I love the regional markets.
Yeah, you own these.
65% of my business is outside of the M25. So yeah, I guess the issue is the fixed cost of doing relatively small loans doesn't change from doing a relatively big loan. You still need people, you still need execution, you still need servicing. So, the barriers to that are quite difficult if you're a small team. So therefore the competitive environment is less, and therefore the liquidity available to borrowers is potentially less. To answer Peter's sort of distribution question, we have done some of this stuff, but actually putting together a data tape or such like and documentation on 1,000 loans is very difficult and very time consuming. I announced something yesterday which will see borrowers given a 45-minute lending decision in the regional markets for small loans. Trade-off is it's very simple, it's very straightforward, it's very standardized documentation, which does start to facilitate some kind of sort of volume distribution if that's what we do. But I think that has to be the answer, because trying to set up a platform and an origination, if you're a small new entrant, to find the markets and find the clients and execute the transactions is really difficult.
I mean, Emma and Michael, give us quickly your observations on this, because I know you are very heavily not in the regional.
Well, we're not, and Paul's already made the point. It's the cost of doing business. I mean, at the moment, most of the wholesale lenders work on an LMA loan agreement, runs to 150 odd pages. That's enough to scare most people off if you're borrowing £5 or £10 million. And so, but the cost of doing that business just isn't worth it. I've made the point in other presentations that 80% of the population lives in the regions, not in London. And so there must be business out there. And I was at a session yesterday with a guy who's doing the MES space, and he specialises in the regions. That's all he does, because he finds opportunities out there. He goes and sees people in the regions, and they say they haven't seen anybody from London ever. Nor do they want to. Which I can relate to. I mean, as a wholesale lender, we're looking for a deal size, so we have no aversion to the property being in the regions. If it's gathered together in a portfolio, we can build the dynamics around whatever we're going to do with it and the value-add plan, then it's fine. It just isn't cost-effective for us to do that, and that's what really... The other aspect, of course, is the values simply are that much lower.
That's the issue. I mean, for us to have a MES loan that's 10 million plus, it needs to be a 50 million asset or portfolio, right? So how many of those are there? Unless
London guys talking 5 to 10 million. 80% of the business in the regions is less than £2 million of borrowing.
Yeah. Yeah, which is probably another reason, by the way, that the clearers, that the UK banks saw their volumes hold up more as the international kind of, forces were buffeting the country. My guess is when we looked at the Bank of England data that actually the small deal market was relatively undisturbed. Let me take a question from the audience and then we'll come back. It's somewhere in the back there.
Hi, Tony Key, Cass Business School. Sorry, a much more general question, but you mentioned the Bank of England. So we've been through a market cycle peak with a subdued level, or indeed a falling absolute level of debt. Would the panel feel that the debt has been overly restricted? Has there been too little debt? Has there been regulatory overkill? Or have we had just about the right amount?
Could you repeat the question, Mark?
I struggle to hear. I'm going to ask you to repeat it. Could you turn up the volume, please, for those of us who are beyond a certain age?
Okay.
That's better.
All from the beginning. Tony Key, Cass Business School. We've been through a market cycle peak with a subdued and indeed a falling level of loan book. Do people feel that there's been too little debt, there's been regulatory overkill, or about the right amount of debt? So what's the conclusion on the reaction to the crisis in terms of subdued demand for leverage and supply of leverage?
You want to take that up?
Yeah, I mean, you know, as a consumer of leverage, as a professional borrower,
You're looking very slim.
Put that on your epitaph.
probably will be. I think the industry wants less leverage because it has seen the volatility and the impact and the difficulty of managing a portfolio or an asset or whatever when you're in a highly leveraged position. So I think there is, there are outlying situations, and I'm sure on the mezzanine market you see it. But I think at the larger end of the more institutional end, demand for leverage is lower anyway, and certainly leverage individually per asset. I think the banks, I don't think it's actually a regulatory issue so much in terms of the banks willing to provide leverage. That has an impact, obviously, on the pricing of it. But I think that everyone has got such a visceral memory of 2005 through 2007 through the institutions. And so I think that the behavior of banks and actually the behavior of borrowers is I think there's almost a consensus really around what the right capital structures are. I think in our case, and limited partners who come and investors who come into our fund are focused on this issue as well. And so they give direction around what they think is an appropriate level of leverage. And so I think the industry is moving to a situation of about right in terms of the way we borrow.
I would agree that our experience on the demand side is that it's just been a fundamental reappraisal of how much debt borrowers want. And we've been tracking for the last 5 years the average LTV across the pipeline of finance requests that we've seen, and it's only only one quarter has it actually gone above 60% across a broad pipeline. I think to try and answer the question about whether or not there's too much lending going on or not enough, are we in a good state of balance? I think going back to that, is it in the right places? And I think it's not reaching all of the right places. And we talked about the regions. We raised some capital specifically to lend on smaller and mid-market loans. So that was 1 to 40 million. And we found that there's really strong demand for that, but it's really, really hard work. And we've had to work very hard on our processes to make that cost effective. But there's certainly plenty of demand for it, which suggests to me that funding is not getting out to all the right places in the market in an equal way.
Okay, I'm going to give the audience an opportunity to ask a last question, because I've got one last question. And one of the things I learned from Ian Marcus, my predecessor as chair at the Bank of England, is that the most important attribute of a good moderator is he finishes on time. And it's 19:28 according to this. I've got 2 minutes left. Is there a question? Yes. Good to see you, William.
A ghost.
Remember, I only got 2 minutes left.
For those of you who don't know who I am, I'm William Newsom, and I retired from Savills a year ago.
Okay, could you turn up the volume, please, because I don't want to go through this again.
Hard of hearing as well. But this is a question about the non-bank lenders, the alternative lenders. When I was researching this time last year, I was able to name literally hundreds of alternative lenders. And there was also, borrowers put a very good case for borrowing from the alternative lenders, not from the banks. So reading the report, I'm amazed to find how small a space the alternative lenders occupy. Where have all those 100 alternative lenders plus that I identified, where have they got to?
I suspect he's looking at you, Amy.
Yeah, well, I'm glad they've disappeared, frankly. Look, I think there are a lot of people out there doing non-bank lenders, but some of them are really just kind of, they dip their toe in occasionally. They're not really out there originating. So I think if you sort of really went to who is actually really has market share, it's probably a pretty small group, and then you'll have people dipping in here and there. So I mean, it's always been the talk that there's so many debt funds out there. We tend to see the same people again and again, is the reality.
Okay, well, I'm going to still take my last question because I'm going to invoke the William Newsom rule, which means you get to extend the meeting by 2 minutes if William asks a question in the last 10. So my last question is effectively a follow-up on my first question, and I'll end on time because you only get one word in your answer. Will 2017, the balance of this year, be a borrower's or a lender's market?
I'll go for lender again.
I'm going to swing for borrowers. There's oversupply of debt.
Split, depending on where you're borrowing and against what sort of assets.
More than one word, my dear.
Sorry.
I'd say borrower.
I'd agree. I think it's a borrower's market this year.
What I want to hear, guys. Good. There's almost consensus. Okay. Thank you, panelists. Thank you, audience. Thank you, Nicole, for a great report. Thank Alan and Overy, all the sponsors. Thanks those of you who asked questions. And I was told that they wouldn't allow us to have alcohol beforehand because they were afraid I would drink too much, but that we might actually be able to have a glass of wine or a beer now. So we are officially now adjourned. Thank you, everyone.